All right, let's dive into a really fascinating puzzle from the world of investing. It's one of those classic dilemmas that can trip up even the sharpest, most seasoned pros out there.
So, what if you found it? The perfect company. I mean, you've done all the research, the business is an absolute masterpiece, a real titan in its industry. But then, the final verdict you get is don't invest. It feels wrong, right? Well, today we're going to unpack exactly why walking away might just be the smartest move you could possibly make.
And the company we're putting under the microscope for this puzzle is Agilent Technologies. We're going to explore exactly what makes it such a wonderful company, and then we'll get to that crucial reason why it still might be the wrong investment for you right now. Now, to solve this thing, we're not just going to use any old framework. Nope. We're going to bring out the big guns, the gold standard, the timeless investing principles of the one and only Warren Buffett. And trust me, it's a method that really forces you to be disciplined and see past all the market hype. So here they are, Buffett's 4 tenets. They sound simple, but they are incredibly powerful. First, you need a business you can actually understand. Second, it's got to have favorable long-term prospects, a great future. Third, it needs to be run by honest and competent people. And fourth, and this is the one to really watch, it has to be available at an attractive price. We're about to see how Agilent stacks up against these, but keep your eye on that last one because it's the key to this whole puzzle. Okay, so first things first, let's build the case for why Agilent is, by just about any measure you can think of, a truly exceptional company. We're going to focus on those first 3 tenets: the business itself, its future prospects, and the people running the show. This quote just nails their business model perfectly. You know the saying, right? During a gold rush, don't dig for gold, sell the picks and shovels. Well, that's Agilent. They sell the essential, mission-critical tools and lab equipment to the entire life sciences industry. It doesn't matter who finds the next blockbuster drug, Agilent wins either way. And a business model like that creates this incredible, powerful competitive advantage, what Buffett famously calls a moat. I mean, just think about it. Their brand is the benchmark for quality. So for a lab to switch suppliers, it's hugely disruptive, it's expensive, it's a massive headache. On top of that, a huge chunk of their revenue is recurring from services. It's like a fortress. Okay, so what about tenet number 3, the people? Well, check that box too. The management team running this show is absolutely top-notch. They have a history of making really smart, rational decisions, they don't chase fads, and they've built a rock-solid reputation for integrity. It's all about long-term value with them. So far, this company looks pretty much perfect, right? And when you look at the numbers, the financial picture is just as strong. Their 5-year average return on equity, it's hovering right around 22%. Now, that is a fantastic measure of how profitable a company is, and it blows past the 15 to 20% range that someone like Buffett loves to see. And you can see that strength plain as day right here. Look at their operating margins. They're not just high, they're actually expanding. What does that tell you? It tells you they have real pricing power, and they're getting more and more efficient. That, my friends, is the sign of a truly dominant business. All right, let's talk cash. That big number you see, $1.3 billion, that's their projected free cash flow for 2024. Think of it like this. After all the bills are paid and the business is run, that's the pure cash left over. That's money they can use for anything: buying back stock, paying dividends, reinvesting smartly. It's basically the lifeblood of a great company. So let's recap. We've got a durable moat, fantastic management, stellar financials. I mean, this company passes the first 3 tests with flying colors. It feels like an absolute slam dunk. So what on earth could possibly be the problem here? And this brings us right to that final, all-important 4th tenet, the one single thing that separates a wonderful business from a wonderful investment, and that is the price. You see, the key concept we have to talk about is the margin of safety. This is Buffett's #1 unbreakable cardinal rule. It basically says it's not enough to just buy a great company. You have to buy it for less than it's actually worth. That discount, that's your safety net. It's your protection in case you're wrong or if bad luck strikes. Okay, so let's apply this directly to Agilent. Picture a scale. On one side, you have its intrinsic value. That's what the business is really worth, deep down, based on all the cash it's going to make in the future. On the other side of the scale, you've got its market price, what you have to pay to own a piece of it today. And the big problem, the red flag, is when those two sides of the scale are perfectly balanced. And that's the entire problem in a nutshell. There is no discount. The market price is already reflecting just how great the company is, leaving basically zero gap between price and value. See, the market isn't stupid. It already knows Agilent is a fantastic business, and it's making you pay full price for it. Your margin of safety? It's gone. Vanished. So what does this all mean for us? How do we take this amazing business on one hand and this not-so-amazing price on the other and come to a final verdict? Well, the recommendation actually becomes pretty clear, but it's a little different depending on where you're standing. If you're someone who already owns shares of Agilent, the advice is to just hold. I mean, why would you sell a best-in-class, wide-moat business? But if you're a new investor thinking about buying in today, the verdict is to stay away. The discipline of this whole approach demands that you wait for a better entry point, wait for that margin of safety. And if there's one thing you take away from this entire analysis, let it be this. The quality of the business and the price you pay are two totally separate judgments. You have to evaluate them independently. A phenomenal company can be a terrible investment if you pay too much for it. And on the flip side, even a so-so company can be a fantastic investment if you get it for a cheap enough price. So the next time you're looking at a potential investment, I want you to ask yourself this simple question. Are you just buying the business, or are you also buying the price? Are you falling in love with a great story, or are you being disciplined about what you pay? Because believe me, the answer to that question can make all the difference in the world.